Steve Weiss, the 10-year yield has been telling us that the markets are concerned about growth for a very long time, and here we have it below 1.4. What do you make of this all?
Well, to me, it's very clear evidence that the market is most concerned about COVID and the variants, and not that concerned about not passing Build Back Better, and not as concerned about the Fed in terms of raising rates, except for the fact, and I'm going to modify that and modify it importantly, that the Fed is tightening monetary policy at the wrong time. So it's growth fears that are hitting everything, and it's pretty indiscriminate. However, I'm staying with my bond short, because I think that this is just a moment in time, and that I haven't seen too many cycles, frankly. I'd be hard pressed to recall any where you started a major rate increase cycle and yields went down. So it's, as I started saying, it's evidence of COVID being the number one factor in the market. Anything else is pure folly.
Liz Young, what do you make of this sell-off?
Well, first, if I'm understanding Steve correctly, he said the Fed is tightening at the wrong time, and I'd have to respectfully disagree in the face of huge inflation. Go ahead.
I didn't say it, Liz. I'm sorry. I'm saying the perception of the market is that. I think the Fed is latent tightening. So okay, I agree with you on that.
Yeah. I think the issue here, Melissa, is that we have uncertainty, obviously, heading into the end of the year. We keep asking ourselves, is the Santa Claus rally at risk? It's already not happening, right? The Santa Claus rally usually starts to take shape about mid-month. We're here on the 20th. There's no rally. I think that we could go lower from here. Maybe we rally into the end of the year, but that's going to have absolutely nothing to do with Santa Claus. It has everything to do with the idea that we have uncertainty over COVID, and we have a Fed that isn't going to save us this time. And frankly, they shouldn't save us. They are tightening at the right time, in the sense that the economy is still pretty strong, regardless of what the market is saying. The economy is doing okay. Inflation is hot. They have to control that in order for the economy to continue growing through 2022. So we need to get through some of this, and always remember, as investors, the market is going to bottom before the bad news peaks. So we're probably going to hear about a peak in cases. Things are going to relax. The market will bottom before that.
And that's what Tom Lee says. Tom Lee of Fundstrat. If Omicron peaks in January, we think stocks will actually bottom in late December. This coincides well with the Fundstrat head of technical strategy, Mark Newton's view that the tradable low will take place. He gives dates between December 22nd and December 24th. The bottom will be this week. Joe, will the bottom be this way? If that is the case, and we can't pick bottoms, obviously, if we could,
Stephanie,
then... Yeah, go ahead. Okay, if we can't pick bottoms, do we just say, you know what, Joe, we're going to buy? We're going to use this as a buying opportunity, because longer term, we know that will have been close to the bottom, at least.
Melissa, good to see you. I struggle with a lot of these short-term calls. I think what is so important and really missing at all times from these conversations, what's the most important word to all of us if we're investors, if we're speculators, short-term, long-term? It's the word risk. The word risk. It's the primary word in the financial services vocabulary, and it's one that's reshaping itself right now. Why? Risk is always present. And we are now coming off a 2021 that has the highest risk-adjusted return for investors in decades. You have low realized volatility, strong performance for the S&P. To Liz's point, now you have a pivot on the part of the Federal Reserve. The abundant liquidity, the oceans of liquidity, they're pulling back on that. And in that process, a lot of the riskier strategies, whether it was allocating to hyper growth stocks or high valuation technology stocks or small caps that were correlated to this roaring 20s narrative that never actually unfolded, risk is now being reshaped, and it's being exchanged from weaker hands into stronger hands. And I think the right thing to ask yourself is Is this the onset of the bear market? Absolutely not, in my opinion. Credit markets are trading fine today. This is a correction that is going to provide an opportunity, and that opportunity presents itself dependent upon where you sit on the risk curve. Are you one of those investors that's assumed way too much risk? Well, if you have, then you're going to need to do some selling. But if you're moderate in what your risk leverage is right now, you're able to sit back, and this will be an opportunity for you when the calendar rolls into 2022.
John Najarian, I have a feeling that you've been very active today. So tell us, John, what you've been doing.
Well, Melissa, I've been active for the last 3 days, I guess. I've been converting stock positions into simulated long stock positions by getting into options, just because the volatility was cheap enough, Melissa. As you know, when volatilities get high, and they certainly popped today, we had readings north of 28 earlier today, but for the spot VIX, that is, Mel. But when we had the cheaper volatility last week, I thought it was prudent to get out of stocks, which I'd been doing for better part of 2 weeks, and getting into call spreads to simulate that same long exposure. So I was doing that in a host of stocks, everything from JP Morgan to Lululemon to, I think, Bank of New York. I can't remember all the different banks I did that with, Mel, but that just seemed like a prudent thing to do.